Well, welcome back. Today I'll be illustrating a fairly comprehensive Chapter 3 type problem. And for this I'm actually using the comprehensive problem it's called, found on page 204 of your 8th edition of the Edmonds Fundamental Financial Accounting Concepts text. And this problem today is going to illustrate one complete cycle of all steps. Now keep in mind in your project, if you're in my course, you'll be doing a 2-cycle problem as a project coming up, and so this will help you as you get into that, understanding the steps of the cycle that you'll be going through twice over in your project, but one set of the cycle steps here. First, we're told that Pacilio Security Services has some beginning balances starting the 13 year. Now that's not in actually trial balance form because it's not using the left and right columns, the debit and credit columns, but all these are assumed to be normal balances. So let's first go through and insert those as our beginning balances, which for cash would be $8,900 left side being an asset. For accounts receivable, let's create that account in our ledger, the ledger being the collection of all our accounts, complete with all period to date activity in each. That's another asset, so that's going to be a left side called debit balance. Supplies, also an asset. So left side are called debit, beginning balance of 65. Prepaid rent, also an asset. And its beginning balance, left side being an asset, 800. Land 4,000 being an asset, that's left side or debit. And then we get into some liabilities accounts, like accounts payable. Well, being a liability, it's going to have a right side called credit, normal balance as its beginning. Unearned revenue, also a liability. So right side called credit, its normal balance as its beginning. And salaries payable, that's a liability. So right side normal balance for it. Of course, in your project, in the first year, I think there's no beginning balances. I think that was their startup year, if you're doing the project for my course. But then the second year, you'll have to carry forward the appropriate balances. It's just those permanent or real accounts, assets, liabilities, and our couple of equity accounts, common stock and retained earnings, that carry that balance. As we'll come to see, the closing process, which is among the very last steps of each cycle, will have closed all those others, all those temporary accounts. Now, common stock is an equity account, so it also has a right side normal balance, 8,000 here. And retained earnings, also an equity account, 2815, its beginning balance, right side or credit. Okay, so we've inserted our appropriate beginning balances. You also could have put that in trial balance form, but no real need here. Let's go ahead and journalize each transaction throughout the period. Number 1 says we pay the salaries payable from 2012. So to decrease the salaries payable liability, a left side entry called debit. We're paying out cash, so to decrease the cash asset here, a right side entry called credit. And we see that salaries payable balance had been $1,200. That's what we're now paying, is all that. Payday has rolled around early this 2013 year on that time they worked and that we accrued last year apparently. So at some point we have to post each journal entry, at least if we're taking time in real life to do so, which in real life we always would. And posting is a mindless rote process. It should require no thought. We're simply transferring from journal, our book of original entry, where we first record each transaction here in the journal, to the affected accounts in the ledger. In this case, there's a cash outflow of $1,200, and that's paying expense of some period, so I can code it there as its operating type as it's changing the cash account here in the ledger. For best form, we'd actually skip lines in between each journal entry, but I'm going to save space here so you can continue to see more on the screen and not skip that line. So number 2, of course, before moving on, make sure you've maintained good form, listing the account or accounts being debited first, those being credited last, and indenting those credits, both the account title and the amount. And before moving on, making sure your debits equal your credits in total for that journal entry. Second event, we pay the balance of $2,000 on the debt that we had borrowed in a previous year, and it's an interest-free loan. We see that $2,000 debt balance showing as our beginning notes payable balance. We're now repaying that principal, so let's decrease the note payable liability with a left side entry opposite what would have increased it in order to decrease it, and pay out the cash, decreasing an asset like cash with a right side entry called a credit opposite what would have increased it in order to decrease it. And let's post that. Of course, they said this was a Small Business Administration or similar loan, so it was not interest bearing. There's a cash outflow here, and it's giving cash back to a lender that's of a principal nature. So I've coded that as a financing cash flow today. There as it changed the cash asset, and we've maintained good form in both our journal entry and posted it as needed. Number 3, we performed $32,000 of security services, $21,000 on account, $11,000 for cash. So the cash asset goes up $11,000, and accounts receivable asset goes up $21,000. Now this is a compound journal entry where we have more than just 2 accounts affected, but that's okay. We're still going to get in balance here in a sec, totaling $32,000 of revenue earned. So I think I'm using the word service revenue. So let's see, let's post that. And this is operating cash flow to the extent of this $11,000 cash coming in today. It's collecting revenue of some period. Those of collecting revenue of some period or paying expense of some period, those are our operating flows. We record revenues always with right side entries called credit. We can remember that because revenues are one of those events that changes retained earnings and that increase retained earnings. And so as we earn a revenue, we record that revenue with a right side entry consistent with it increasing retained earnings, equity, and substance. Just doing so to the more specific revenue temporary account. I've posted all that, maintained good form, listing our accounts being debited first, those being credited last, and indenting those credits. Number 4. On May 1st, we pay $3,000 for 12 months rent in advance. So prepaid rent asset increases. We're paying out cash, so the cash asset decreases with an opposite right side entry in order to decrease that asset. Maintaining good form here. Listing the account being debited first, the account being credited last, and indenting that credit. And even though it's not yet today's expense, it's today's operating cash outflow. Remember, for now, this is entirely something of benefit. We get to use our office facilities for the next 12 months, starting today, May 1st, and we've already paid for it, so that's something of benefit, a prepaid rent asset for now. Number 5, we purchase supplies on account. The supplies asset going up with a left side entry at the moment of purchase, unless told otherwise. We'll assume those are going to be on hand for now, something of benefit. Going on the supplies shelf. And we owe our vendor more, so we increase the account payable liability with a right side entry called a credit. And I've posted that. Now, by the way, you could be using a posting reference, never a bad idea. Some kind of little simple tick mark or check mark or something as you make each posting. That way you don't lose track of where you've left off in your posting. 6, we pay salaries expense for the year, $9,000. We record expenses always with left side entries called debit. We've incurred expense as our employees are working for us on the clock. We also paid this, so the cash asset goes down today with a right side entry called credit. Now, the way we can remember that expenses always get recorded with debits or left side entries is because expenses, remember, are events that are in substance decreasing retained earnings equity, and so a left side entry consistent with doing so, just selecting the more specific expense temporary account, but that left side entry recording it just as if we're decreasing retained earnings equity and substance overall, which in substance expenses are doing as we incur those expenses. This is paying expenses some period, so it's today's operating cash flow. I've recorded it as such as I posted it to the cash account today. 7, we incur other operating expenses on account. Now remember, when you see that phrase on account, that generally means on credit. So cash will change hands later, not today, but something happening today. We record the operating expense with that left side or debit, it's called, entry, as we record all expenses with. I'll create that expense account and post it. And then, since we owe our vendor more today, increasing the account payable liability with that right side entry called a credit. Up to number 8, where on October 1st, a customer pays us $1,200 for services we'll be providing them over the next 12 months. So today, October 1st, we're getting this money in advance from a customer. We increase the cash asset today. When we owe services, as we owe them all 12 months worth for now, we increase the unearned revenue liability. And of course, to increase the liability account, a right side entry called a credit. And I'll post it. Which I've done. By the way, there's a cash flow today, and even though it's not yet today's revenue, it will be becoming revenue of some period in these 12 months ahead as we get into doing some of the work. And so it's today's operating cash flow accordingly, collecting revenue of some period. Number 9, we collect $19,000 of accounts receivable during the year. So we increase the cash asset. We decrease the accounts receivable liability, asset rather. And of course, increasing an asset like cash needs a left side or debit entry. And then to decrease the account receivable asset requires the opposite, a right side called credit entry. So let me post this. It's today's operating cash flow. Even though it's not today's revenue, it's really more like yesterday's revenue. But still today's cash inflow that's collecting revenue of some period. Up to number 10, where we pay $59.50 on our accounts payable. To reduce the account payable liability, a left side called debit entry. To decrease the cash asset, a right side called credit entry, $59.50. Let's post it. And even though it's really not today's expense, it's still today's operating cash flow that's paying expense of some period. It's probably yesterday's expense technically. Number 11, we pay $1,800 of advertising expenses for the year. We record expenses with those left side entries called debits. And to reduce the cash asset, a right side entry called a credit, $1,800. I'll post it. And this is paying expense of some period, so it's today's operating cash flow. And number 12, we declare and pay a cash dividend to shareholders, those are our owner stockholders, of $46.50. The dividend's temporary account we record with a left side entry called debit. Dividends, that other event that decreases in substance retained earnings equity as we declare that dividend. And so that left side entry, recording the dividend event, just opting for the more specific dividends temporary account, is consistent with it decreasing in substance retained earnings equity with that left side entry. And this is giving cash back to owners, so it's today's financing cash flow. Give me a moment and I'll add a couple more lines. I'm running out. Okay. Bringing us up to number 13, which is really a non-event. Remember, that's a fluctuation in market value of the land, and we don't capture that fluctuation in market value of most assets. So really a non-event for 13. 14, we're now at year end, and we're going to need a few adjusting journal entries. We actually could have gone ahead and prepared what's called an unadjusted trial balance at this stage before making our adjusting entries. We could have scanned through that unadjusted trial balance to identify some accounts needing further adjustment, and then that becomes the driving force in our preparing the right adjusting entries. In this case, we can really just scan through the ledger and do the same sort of thing. Basically, the accounts that should jump out at us for sure, and there may be still others that they tell us we need to accrue, but we know we've earned some of that formerly unearned revenue. The earned portion needs to get moved out of the liability into real revenue temporary account. Odds are we've used up some of those supplies, showing unadjusted $765, needing to shift the used up portion out of the supplies asset into what will be a supplies expense account. And the prepaid rent showing an unadjusted $3,800. We've obviously used up a good bit of that time on the lease by now, December 31st, that we need to shift out of the prepaid rent asset into what will be a rent expense account. Those are the ones that we should have identified for sure, and they'll also tell us number 17 that's something else we need to accrue. So 14, we'll just head straight into our adjusting entries. So these are technically adjusting, end of period adjusting journal entries. You don't really have to label these separately, but just so you're aware, that's what these are now becoming. So 14 is they tell us 120 of supplies remain on hand at year end. Well, we show an unadjusted 765. I'm not going to take time to tally that up, but I think you can see that's an unadjusted 765. It needs to become reduced down to 120. So that's a difference of 645, I believe, that we need to reduce it. And we'll see once we post that. That's going to leave it where it needs to be. Reducing the supplies asset, and as supplies or as assets in general get used up, we shift their used up formerly asset portion out of the asset and into the appropriate expense account, in this case supplies expense. Of course, we always record expenses with that left side entry called debit, remember. Consistent with expense as we incur it, decreasing in substance retained earnings equity overall, just opting for the more specific expense temporary account. I think I will go ahead and draw my line here, and that way you can clearly see we've brought it to an adjusted ending balance where it needs to be. So 765 left side subtotal minus 645 right side subtotal does in fact bring it to the proper adjusted 120. Number 15, the expired rent. And when it comes to transactions like this, it's often helpful to refer back to the original earlier event, and that being number 4 earlier in the year, where on May 1st we had paid $3,000 for 12 months rent in advance. If you divide that by the 12 months it covers, that comes to, let's see, that's going to be $2,500, I believe, per month, $250 rather, per month lease cost under the current lease. That was on May 1st. Of that particular lease, of course, there also have been some beginning balance that's all gotten used up prior to May 1st that we need to move out of there, out of the prepaid. But of this new lease that we prepaid May 1st, the months of May, June, July, August, September, October, November, and December, 8 months, have now gotten used up of that, which technically is 8 times 250, which comes to 2,000 of the 3,000 used up. Plus we've used up all 800 that was prepaid starting the year. So we need to move 2,800 out of the prepaid rent asset. What that is 8 months at $250 under the new lease, totaling 2,000, plus the prepaid starting the year that represented the months January through April. The old lease apparently was at a lower monthly rate, $200 per month. But that totals 2,800. Now another way that you can get to the same adjusting entry here is to focus on what do you want the prepaid rent asset balance to become, and we're still prepaid 4 months as of today, December 31st. We're still prepaid and at the rate of $250 per under the current lease for the months of January, February, March, and April of next year, totaling 1,000 desired prepaid balance in the asset. And you'll see once you post this, if I update the balance, that we have brought it to that desired 1,000 of ending in the prepaid asset. So our adjusted balance checks out to the 4 months at $250 per, totaling 1,000 still prepaid. And number 16, we recognize the earned revenue from 2012. Now that was last year's, where a customer had paid us in advance last year and started as unearned revenue liability to that extent beginning this year of 200. They're telling us we finished earning that, plus we need to finish or we need to figure out how much of this new 1,200 we've now earned through December 31st. So refer back to that earlier event earlier this year, earlier event number 8, where on October 1st earlier this year, customer had paid us $1,200 for a 12-month contract. It was in advance at that moment. We owed them all $1,200 of services at that moment, but now we're earning, or have now earned, several months, specifically 3 months of that, October, November, and December. When you divide the 1,200 by the 12 months contract period it covers, that's 100 per month that we've earned. So 300 of that 1,200 we've earned, but they're also telling us we've earned the 200 that was the beginning balance. We've done the work sometime this year to complete that as well. So the 300 of the 1,200 now earned, and plus the 200 that was the beginning balance also now earned, is 500 of that unadjusted 1,400 that we've now earned. We've done the work to this extent through December 31st. So let's move it out of the unearned revenue liability with a left side called debit entry to decrease that liability, and let's move it to real revenue, service revenue, which we always record revenues, remember, with right side entries. As we know in substance, revenues are increasing retained earnings equity as we earn that revenue. Now you're going to see once I update our new balance in the unearned revenue that we will have brought it to the desired ending liability balance of still $900 owed. We do still owe this customer services for 9 months at $100 per, totaling $900. This work we'll be doing next January through September. But moving the earned portion, $500, to real revenue, service revenue, temporary account. Now remember, you shouldn't have to think about your postings. All you're doing with posting to the ledger is transferring, as your journal entry said to do. And lastly, number 17, accrued salaries were $1,000 at year end, which means we've had our employees working for us on the clock here this year, some late in the year probably. Payday has not yet rolled around and will not until early next year, but it needs to be this year's expense because this is the year they worked on the clock. We also owe them this much more wages for now at year end, so let's record the salaries expense with that left side entry called debit, as we always record expenses with, and let's increase the salaries payable liability with the right side entry called credit. So if we update some more of these balances, that brings salaries payable to $1,000 owed at year end as adjusted, and brings notes payable to 0. We had paid that off earlier in the year, that principal balance. Let's see, service revenue brings it to $32.5. Salaries expense brings it to $10,000 we've incurred. These are our adjusted balances. A lot of these others are obvious. Got a few more to do. So accounts receivable finishes at $3,500 that our regular credit customers owe us. Accounts payable liability, representing monies we owe to our regular credit vendors. Let's see, that's going to be, let me just do a formula to be safe. And lastly, our cash. What happened? Okay. And let me do a formula on it to be safe. Looks like 12.5. So we have prepared and posted all our needed journal entries, the last several of which were adjusting entries for the year. So we've completed A and B of the requirements. C is to prepare then a trial balance. Let me just stick it down here maybe. And this is as of 12/31 of 13. And a trial balance is pretty straightforward. We're simply going to list each account name and just name and balance, left or right as the case may be in each case. And we see our cash balance was left side being an asset as expected, 12.5. Accounts receivable, for best form we try to group our assets first here. Supplies 120. I'm just taking these adjusted balances from our accounts in our ledger and then restating them just name and balance, left or right as the case may be. We have some prepaid rent. This is technically the adjusted trial balance, or you might have work papers that call it the before closing trial balance. A land asset, 4,000, unchanged historical cost on that. Moving next to our liabilities for best form, accounts payable of right side as expected 5250. That's its balance, by the way. Unearned revenue 900. That's where we owe some services. To some customer. Right side as expected being a liability. Salaries payable 1,000. That we owe our employees till payday rolls around on this time they've already worked for us on the clock. No notes payable, I'll skip that. Moving to our couple of equity accounts for best form next. Common stock 8,000, right side as expected, as is normal being an equity account. And retained earnings 2,815, right side as is normal being an equity account. Now just to stress, that is technically the beginning balance for that one account, and that's the one account still showing beginning at this stage in the process. That's to be expected, because for everything that was in substance changing retained earnings during the period, we opted instead for the more specific temporary account, some revenue account, some expense account, or the dividends temporary account. Makes it easier to prepare our financial statements. So that retained earnings is the one account still showing its beginning balance at this stage, and that's to be expected at this point. The dividends temporary account, 4650 left side. I'd probably show it next for best form, and then our revenue accounts. In this case, one such, service revenue of right side 32,500, as is expected, as is normal for a revenue temporary account. And lastly, our expense account groupings, operating expense 4,200. Left side, as is normal for a expense temporary account. Advertising expense. Left side, as is normal for an expense temporary account. Supplies expense. Left side, as is normal for an expense temporary account. And rent expense, 2,800, as is normal for an expense temporary account. And then we can subtotal each of our two columns. Let me stick in a formula. It's going to be that through that, and here similarly. And we have some problem. So either I have a problem in an earlier formula, or I have overlooked some posting, or I have overlooked some account entirely. So let me see if I can find my problem here quickly. I guess. Shouldn't be the problem there. And that shouldn't be the problem there. So I'm going to pause at this point and try to find my problem without wasting your time. Okay, I found my problems. I actually had two problems. I had a problem in my formula for the accounts payable balance, and once I fixed that, that came to a zero ending balance. So I've made that change here on our trial balance, accounts payable now zero. The other thing is I have forgotten to pick up the salaries expense in my trial balance here. So I'm going to insert a row and create that salaries expense temporary account, and its balance 10,000 left side, and that's going to put us in balance. So that's what we have to do if we show to be out of balance in the trial balance, is try to find our issue. And now we can see both columns do agree. So our left side are debit balances equaling, as they should, our right side are credit balances. And this is technically the adjusted trial balance that reflects nice adjusted balances, or you might have some work papers that might call that a before closing trial balance. Well, once we have these nice adjusted trial balance figures, we can use those to prepare our 4 financial statements, starting with the income statement, and that shows revenues less expenses. We have more expense types than that, so I'm going to go ahead and pre-insert some rows there for some of those other types of expenses like salaries expense and supplies expense and rent expense and advertising expense. We had some of that. Maybe one more. Now we can pull these figures, these nice accurate figures, from our adjusted trial balance. The service revenue we earned we see to have been $32,500. We incurred this period salaries expense $10,000. And operating expense $4,200. And advertising expense $1,800. And supplies expense $645. And rent expense $2,800. So I added one too many rows there. Okay, so in this case what I would probably do is subtotal those expenses, since there's more than one type we incurred during the period. I'm just going to stick in a quick formula here. And then the net income of the period should be the revenues minus the expenses. So $13,055. And this is, we could get more specific, for the year ended 12/31 of 13. We could put the company name as well. I won't take time. Now that we've come up with net income particularly, we can move to our statement of changes in equity next. Common stock, if we refer back to that account in the ledger, we see started and finished at unchanged 8,000. So you could either just say it began at 8,000, that there were no issuances, and it finished at unchanged 8,000, or you could have omitted this first half altogether, renamed it a statement of retained earnings or something along those lines. We do actually know our beginning retained earnings from our adjusted trial balance. Remember, that is the one account at this stage still showing beginning, 2008-15 of beginning retained earnings. Of course, 3 types of events we'll say for now change it. Revenues increase retained earnings, expenses decrease retained earnings, dividends decrease retained earnings. But 2 of those 3 events, revenues and expenses, we've already detailed for the user in the income statement. So let's save time and space here. Summarize those revenues less expenses as the net income figure straight off the bottom line of the income statement we did first for that reason. But since dividends are never included in the income statement, we do have to show separately those dividends we declared out during the period, $4,650, reducing retained earnings here. And I'll just stick that in as a formula. So our true ending retained earnings are the beginning plus the net income less the dividends, to finish at a true ending 11,220. And that's the reason we needed to do this statement of changes in equity just before the balance sheet, so that we'll have the correct ending retained earnings, because that's the one account not yet updated in the books at this point, remember. So common stock we see finished at 8,000. On the balance sheet, we're of course going to show all our assets. I need to insert some rows. All our liabilities. Let me get rid of that underline. Not needed at that point. So let me insert some liabilities rows. Maybe that'll give me enough space. So our assets, back to our trial balance, adjusted trial balance, consist of cash 12,500. These are ending balances, remember. This is at 12/31 of 13. And what the balance sheet's doing is proving in detail that accounting equation that our assets equal the claims against those. Accounts receivable, 3,500. That's where our regular customers owe us some money to this extent. And supplies, 120 on hand today. And prepaid rent, 1,000 today. And land, 4,000 today. It's historical cost. So let me stick in a formula to sum those up as total assets. 21,120 today. Liabilities, these are the debts we owe. Back to our adjusted trial balance. We owe some, could have been accounts payable, but in this case 0. I'll skip it. Unearned revenue, 900. Where we owe some services to that extent today. Also, salaries payable owed to our employees, 1,000. Now be careful, we're looking for the salaries payable liability here, not the salaries expense that belonged on the income statement. We're looking for the unearned revenue liability here, not the service revenue that belonged on the income statement. We're looking for the prepaid rent asset here, not the rent expense that belonged on the income statement. We're looking for the supplies asset here, not the supplies expense that belonged on the income statement. So with very rare exceptions, every type of account, every account belongs on just one of the 4 financial statements, generally speaking. So total liabilities today, those were the only ones we owed today, come to $1,900. Total equity today is 19,220, I can see. And making total claims, the liabilities 1,900 plus the equity 19,220, totaling 21,120, equaling our assets as it should. So we've proven the equation we set out to prove here on the balance sheet. Lastly, our statement of cash flows for the year. And that was the reason I coded each of those cash flows as they changed the cash account in the ledger. Most of ours are operating. We have operating inflows of, if you total these inflows. Now I know these are inflows because they're on the left side of the cash asset account, so they must be increasing an asset account like cash accordingly. And those total 31,200 of inflows. So you could call those inflows, you could call it revenues collected, inflows from customers, whatever. We had outflows on the right side of the cash asset totaling, let me just quickly do a subtotal, and that'll save time on how much those were. Those were 27.6 of outflows. So what you could do is show those as operating outflows and then subtotal the section, which looks like that's going to be 3,600 inflow, the 31.2 minus the 27,600. Investing flows, we scanned through to see if we had any IAs. If so, we'd have put those there, but in this case, none. We have two financing flows, both are outflows. 2,000 repaying that note payable, and 46.50 that was paying, was it a dividend? Must have been, yes. So let's give it those somewhat more descriptive. Something. Your descriptions do not have to be exactly the same as mine, just some little more specific blurb so the user gets a better idea. And subtotal the section. That's an outflow from financing, 66.50. Of course, you could have skipped investing here since there was no investing flows. So the net change in cash is the combined three subtotals. Let me do that as a formula. And that comes to an outflow in the net of 3,050 for the year. Explains to the user why we went from beginning 8,900 cash to what should be, let me put it in as a formula, ending cash as was reported on the balance sheet. But I'm not agreeing. So here again, I'm going to pause and figure out. I probably have a formula problem somewhere. Let me pause the recording. Okay, I'm back. I had forgotten that included on those right side outflows of the cash account, not all those were operating, so I had to correct that figure here. The operating outflows total 20,950, which makes our revised operating subtotal 10,250 inflow for the period, that when combined with the other financing, in this case only subtotal, comes to a net inflow of cash for the year 3,600. That, when taken into consideration with our beginning 8,900 balance, brings us to 12,500 of ending cash balance, and that does agree, as it should, to actual ending cash as we reported on the balance sheet. So that concludes our 4 financial statements and requirement D of your problem. Requirement E is to journalize and post the closing entries. Well, we always start in the journal, our book of original entry. Closing entries we don't do until after we're done with the financial statements, but then we can close the temporary accounts, all revenue, expense, and the dividends temporary account. I'll close them in that order. In this case, there's just one revenue temporary account to close, and that is service revenue. It has a $32,500 right side balance, so here's the rare case we're going to debit a revenue account is to close it in order to zero it out. And the other side of each closing entry is moving those to the retained earnings equity account, as we knew they in substance changed all along. We just couldn't yet put them there. We were opting for the more specific and this will bring it to a zero post-closing balance after our closing entry gets posted. And moving it to retained earnings, we need to close expense temporary accounts. So this will be the rare case where we're making right side entries to those expense temporary accounts in order to zero them out. Normally we're recording expenses with left side called debit entries, but to close them we will have to do the opposite. Now I'm going to stick retained earnings here as the placeholder for the other side, because we will be moving them to retained earnings. So zeroing out salaries expense with a $10,000 right side entry. Zeroing out operating expense as we're closing it with a $4,200 right side entry. Zeroing out advertising expense with a right side entry to it. Zeroing out supplies expense. $645 with a right side entry to it. Zeroing out rent expense with a $2,800 right side entry to it. And the sum of those credits being $19,445, increasing or decreasing rather, I should say. Retained earnings is the other side. So let me post that debit. Well, let me post all these. Let's see, salaries expense. Wow. And that debit to retained earnings, $19,445. Of course, you'll find that did bring those expense accounts to a post-closing balance of zero. I don't really have room on that left side right at the moment. To reiterate, that is the post-closing balance, but that is what it is. Okay. Give me a line, thank you. some of this stuff would be more quickly illustrated just with pencil and paper, or as I do on the board in the on-campus sections. Excel's not always the fastest for every accounting function. It's good for many things, but not always. Anyway, the last temporary account to close is the dividends temporary account. It will be reducing retained earnings as the other side of it, and to decrease the dividends temporary account, a right side entry in order to zero it out. So it's the rare case closing it where we make any right side entry to it. And so I have now journalized and posted our closing entries. And you'll see that brings retained earnings to its true ending balance, showing in its account in the books for the first time. Let's see if I can do it this way. That should have worked. Let's see if it agrees. No, that's not going to work. I didn't do that formula right. Okay, let me do T9 and 10. Minus S11 to 12. 11 to 20, and that does agree to what we derived on our statement of changes in equity as the true ending retained earnings. So it's the closing process that finally brings it into agreement with that. But that's the one account that up until this point has been showing beginning all the way up until this point. We've zeroed out supplies expense, we see. So that's the closing process illustrated. Closing each revenue temporary account, each expense temporary account, and the dividends temporary account. Some students like to do each of these closing the expense accounts in separate journal entries. That's fine. Some people might even make all three of these one big journal entry. That's typically not recommended really, but it would achieve the same end result. So we have E, prepared and posted the closing entries. And lastly, F, the last of the trial balances, called a post-closing. I'll just modify, of course in real life or in your homework you would make this a separate one, but we're again listing each account and its balance left to right as the case may be. Cash 12.5, accounts receivable 3,500, supplies 120, prepaid rent 1,000, land 4,000. All those are asset accounts that continue to carry that balance into the next period. And our liabilities, accounts payable 0, unearned revenue 900, salaries payable 1,000. And our couple of equity accounts, common stock 8,000, retained earnings no longer showing beginning on the post-closing. We've brought it to its true ending of 11,220 post-closing balance. And what you'll find is that all these temporary accounts have now gotten zeroed out. You really wouldn't have to even take time and space listing those. They've all gotten closed. So I could delete those rows and we'd see this post-closing trial balance would be pretty short. just listing those carrying a balance still, those permanent account types of assets, liabilities, and our couple of equity accounts, common stock and retained earnings, and still in balance as we should be, and all the temporaries having gotten closed to zero. So that is the last step of the period, the post-closing trial balance, and hopefully you have found this helpful and can refer back to it to assist you in doing your project. Of course, you're doing 2 cycles over in your project. So this is 1 cycle, 1 whole year of all steps, journalizing, posting, getting to the end of the period, doing the unadjusted trial balance. I've now changed it, but preparing your adjusting entries and posting those, preparing your adjusted trial balance though your project doesn't ask for the unadjusted, using those adjusted trial balance figures that are the nice accurate balances for our financial statements. Of course, cash flows you have to figure out from your cash account. And then the last steps of the period, that closing process, preparing those closing entries, zeroing out each temporary revenue, expense, and dividends temporary account, moving those to retained earnings as the other side of each, and then lastly, after you've posted those, your post-closing trial balance. So hopefully you find this helpful, and continued best of luck.